Welcome to the daily update, where I'll go over the action in the market for Friday, May 16th, and we'll see how things look for Monday, May 19th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, had a really good week. We were up again on Friday, and it seems like, oh, yeah, the market's looking tired. It's looking exhausted. And what does it do? It keeps going up. Now, we are seeing some negative divergences, but that's why we look at charts. We don't rely on our feelings or any kind of gut reaction that we might get to this, because the market can pretty much defy that all the time. And that's kind of what's happening right now. Now, Friday was options expiration. We didn't see volume pick up all that much. It was actually below average, but we keep going up. We're seeing a lot of damage that was done as we were really going down in April. Some shorter term indicators that we have and even longer term indicators that we have are showing some real improvement here, but there's always some things to be concerned about. That's the approach that is used with these videos. We don't rely on one or two indicators because they break down at some point. We look at everything together, and I call that the consensus approach, where we take all the information that we can, put it together, and then reach a conclusion based on that, realizing that it's never going to be black and white. The only times it is black and white, that's usually when we're either at a top when it's white or at a bottom when it's black. That's about the time everything's getting ready to shift. So if you wait for everything to line up in one way or the other, it's usually just at the wrong time. Okay. Now, going back over what happened right at the open, we had a higher open and prices chopped along the unchanged level. There wasn't an awful lot of conviction. Usually the open gyrates around, but hasn't the last few sessions. And we just chopped along the unchanged level, but then we broke out. We actually climbed above R1 at 59.39. Then prices were able to hold above that. We didn't really see any wave of selling coming into the market. We did go up to 59.50, and that's where we hit resistance, another round number. But then we were able to climb above it. So we hit that 59.50, came back, we went back above it, but we didn't get quite up to R2 at 59.61. But even yet, we still closed at the intraday high on Friday. We were up 0.7% on below average volume, which is surprising. It was options expiration, but we didn't really see a pickup in volume overall. And we are positive when you compare price to the 20, 50, and 200-day moving averages. So that means we're positive in the short, intermediate, and long term. Interest rates, we just want to keep an eye on those, watching that 4.5% level with the 10-year yield. And then what happens with the trade wars, the tariffs, and what's going to be happening with the economy. That there's still a lot of variables about that. You go back about a month ago, and all of the looking out into the future that people were doing was all negative. Well, now they're starting to think that maybe things are looking a little more positive. Not so much from people, but when we look at the charts, the stock market is anticipating that things might be pretty good. And there'll be the weekend videos that I do where I break down some different markets, and some of those we get some insight as to what's happening in the stock market itself. All right, some comments. After the close, though, Moody's came out and downgraded the U.S. credit rating on an increase in government debt. So we had been at AAA, that's their highest rating. Well, they ticked it down one notch to big A, little A1. Okay, is that double A1? All right. So that could have an impact. Now, it did come out after the close, so the bond market, the stock market didn't have a chance to react to this. And there might be a reason why they said this on a Friday after the market closes. The Dow is now positive year to date, so we have the S&P positive. Now the Dow is joining the club. But we're getting a pretty long list in the short term of those things that are extreme positive, or you could say overbought. Now, as I like to point out, there are charts that are always on here just showing that we're going up or we're going down. And that includes the StochRSI, Williams percent R, CCI 1420, and Stochastics. Those are the usual charts that we see. Now we're starting to see some charts come up on this list that we don't see as often, such as the VIX. It's going down pretty fast. And I use an RSI based on 9 periods to show that. And we're getting kind of extreme negative, which means the VIX has been dropping as fear's been coming out of the market. Also, the short-term advanced decline ratio, we don't see that on this list, at least lately, as much. We're still looking extreme with the 20-period exponential moving average of the S&P than the usual ones. Now, the rate of change going back 10 periods, that's fallen off the list, but we still have the shorter term rate of change 5 and a little bit longer term, but still in the short term, the rate of change going back 20 periods. And we continue to be far away from the 20-period moving average. That's the boom 20. The slope oscillator, our short-term oscillator, really extreme and even becoming more extreme. And then the short-term RSI. Now, don't confuse that with the VIX. The RSI here is based on the S&P 500. The RSI that I talk about, the VIX RSI, that's an RSI that's calculated on the VIX itself. And then our 20-period moving average study. We've got an extreme reading with those stocks in the S&P that are above their 20-period moving averages. Intermediate term, also seeing kind of a long list here and things that we don't see all that often, just suggesting that we're overbought. The 50-period exponential moving average on the S&P, the CMB composite, which has been there for a few days, and we're even above the +3 channel with our standard deviations chart. So that's pretty extreme there. We're back to looking extreme with the McClellan Oscillator for the S&P. Now, the NYSE McClellan Oscillator, it's not. And there's a bit of a negative divergence there where we're setting a high with the S&P, but not across the broader NYSE index. And the PMO itself is now looking extreme, as well as the studies that we look at. The MACD, that's another momentum oscillator, starting to look extreme. The TTM Squeeze, it's been extreme now for quite some time. And then the bullish percent indexes for the S&P and the NASDAQ 100, and we're also far away from the 50-period moving average. No changes overall to the scenario that the Fed, the last that we really heard from them, they're concerned about inflation going up and growth going down. And the dollar was up. It's above 100 again. So maybe we bottomed out there as far as the dollar is concerned, at least for a little while. And interest rates were down. We closed at 4.44% with the 10-year yield, where after Thursday, we were at 4.46%. Sentiment is positive. We're still not extreme, but we're getting kind of close. When we get up to 75, that's when we're like, okay, maybe the party's a little too excited right now, and it's getting ready to fizzle out a little bit there. But it is positive since we're at 71, where we had been at 69. And we're still not quite, well, we are starting a trend here, but we're not quite ready to be confirmed yet. And I'll show you that chart. We're above the moving average and we're positive with the green line above the red line, but we're still below 20. We need to cross back above 20 for that to be a confirmed trend. With the update, the bias is positive and the momentum continues to be positive there. We did get housing starts, which came in a bit weaker than expected at 1.361 million. They expected 1.383 million. Excuse me, and up from the 1.339 million that we saw last time. Building permits also weaker than expected at 1.412 million. They had expected 1.45 million, and it's actually down from the 1.481 million that came in the last reading. I do have charts of housing starts and building permits, but these next few ones, import export prices, they don't have that big of an impact, but we still like to go through the numbers. Import prices were up 0.1%. Last time they were down 0.4%. When you take out oil, they were up 0.4%. Last time they were down 0.1%. Export prices up 0.1%, which is the same as what we saw last time. Also, when you take out agricultural products, the same reading is what we're seeing before. So any impact on tariffs doesn't seem to be kicking in, at least yet. Now, consumer sentiment, I do have a chart of this one. People are still not real happy about things. And they tried to kind of explain it away. Well, maybe they asked these questions right before a lot of these trade deals were announced and before things with China look like they're more promising. Okay, fine. We just have to take it for what it is right now. And it is lower than expected. They thought consumer sentiment would come in at 55. It came in at 50.8, and it's actually down from 52.2 from the previous reading. Okay, so here are housing starts, and this is the 3 month average. The starts are flat here. That's the blue line. The building permits are declining here. And the housing starts actually coming up a little bit on a seasonally adjusted annual rate here. So that's showing a little bit of an improvement there. Here's consumer sentiment. Everything is going down. Now, the reading that we have, the next chart after this that I show, it's the blue line, and that's the total reading where that continues to go down. The purple line is how people are feeling right now, and the yellow line, that's how people are feeling off into the future. So we look at it here where we are coming down. And now interest rates have been coming down a little bit, but for the most part, we've been seeing more of a disconnect between the two for the last couple of years, where quite often they have a tendency to go in the same basic direction. So we'll see if the stock market starts doing better, if the economic reports coming out seem to be okay and employment tends to hold up, then there's a chance that these negative readings could start to improve. All right, now looking at the buybacks against the S&P 500, and this is why I say when a company announces or actually does end up doing a buyback, it's positive because, and that usually happens in a positive environment. And we've been seeing an increase of that now that earnings season is starting to end. And so the S&P has been going back up, and now we're back up into the blue area here, where we're seeing a lot of the 4 week average continuing to go up overall and be positive with the buybacks. All right, then, okay, and I'm not going to go through all these numbers here, but it's the performance of the S&P after a 58, after greater than 58% of those components in the S&P. There's 503 stocks that make up the S&P. They make a new 20-day high. So really good outlook here. So you look out a month later, up 80% of the time, and 3 months later, 85, 6 months, 85, a year out, 100% of the time. That tends to be positive going forward with really nice average and median returns along the way. Total known ETF holdings in gold. I guess maybe there's some phantom holdings in gold somewhere. It's been coming down a little bit here. We're not really seeing the real wave into gold, people chasing it. They're busy chasing other things right now. But it's still pretty high, but it has been dropping down. And then S&P is still mired in a negative regime. Okay, well, we're looking a little better here, but it's still coming up with this red line here. This is a Bloomberg chart. And what we need to see eventually here is this to turn back over to green. Now, Friday was options expiration day, and this just gives you an idea of the value, the notional open interest of options and what their value was. Awful lot of wealth here, or that a lot of it just vanished. Okay, 2.8 trillion notional right here. And then we did get retail sales. So usually right after that, we get this other chart, which one of the things, looking at the charts when I did yesterday's video, we see this flattening out a little bit more in the chart that I was showing. We're seeing this going up a little bit here, which is actually more positive. Because a lot of times it's not that retail sales really go down until we get into a recession, but they do have a tendency to flatten out here, which is what we saw going in, right? This is right around 9/11. And then they said, go out and buy, refinance your house and go buy some things. Well, here's the great financial crisis where it was pretty much flat. And then we saw the downward move there. And then we were pretty much flat. And then the COVID crash. And we've been going flat here, but it looks like we're actually seeing some improvement. All right. Then U.S. exceptionalism and equity reversed at the start of 2025. You've got other markets outside of the U.S. that have been doing better so far in 2025. And now you have people chasing those markets, which might mean that it's getting ready to shift back to the U.S. But this is just the blue line here, the US versus non-US equities, and they've been performing better. And I have some other charts to show you about that. The US just against Europe, that's the light blue line where it was doing better. Now it's starting to pull back. And then the real US, okay, what's TWI on the right-hand side? Okay, whatever that means right there. That's also been going back up. I'm not sure. They don't have a thing for TWI here. Oh well. Twice win indicator, who knows? All right, and though even though we've been seeing some weakness in the tech sector, that's still where most of the money goes. That is the real growth area of the market. Then here's some charts from a different location. This just talks about how the Moody's came out and they decreased it by one notch to AA1 here, citing persistent large fiscal deficits and rising debt affordability concerns. I mean, you're getting all these trillions of dollars in debt, and it's like, when is reckoning day going to happen? And the agency expects a deficit to grow from 6.4% of GDP to nearly 9%. Of course, you can predict any number you want off into the future because it will change. So this is just showing the federal deficit against GDP, and that's a dangerous thing. And the government is always in debt, but it's like getting debt on steroids now, and that's really causing some longer term concerns. But we spent so much of the time kicking the can down the road. It's like, okay, this really has to be dealt with. We can't just do things to kick it down the road this time as well. And then earnings are improving in emerging markets, slowing in developed markets. The red line here, this is why some folks are finding it more attractive to go into earnings into emerging markets because their earnings are improving. And then the developed market, okay, that this light blue line is actually coming down. And then here we have the world all together overall. But you can see that still the earnings are greater in the developed markets, but they're improving in the emerging markets. All right, then cyclicals against defensives, even after downward revisions to growth forecasts, cyclicals are expected to continue to outpace defensives. Cyclicals, they cycle with the economy. That's why they call them cyclicals there. So they think they'll do better than defensives. Cyclical sectors are now expected to open up and average blah, 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 blah. Okay. So they're just showing this should be improving a little bit, which could end up being more positive for the market. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. All right, here's the intraday chart. Not a real gyration at the open here. We did have a higher open and just kind of chopped along. We tried to break lower, but that didn't last long. We ended up finding support at the unchanged level. We finally made our way up to R1. We got up to 59.50, backed off of that a little bit, but then we're able to break above 59.50. And even though we didn't get up to R2, we did close at the intraday high. And then we're seeing a little bit of a downward move here. That's probably a reaction to the Moody's downgrade. So we'll have to see what that does to the futures when they open Sunday evening. We're still looking pretty good here. Large cap growth versus value intraday. The blue line's above the red line. And we're trailing off a little bit here with S&P intraday growth to value here. Not changing the overall trend that we're seeing, but not showing an awful lot of strength right now either. We need this to continue to go up to be more positive. So our end of day chart growth was up less for the large caps, up more for the mid caps, and up quite a bit more here for the small caps. So, but still, with our small cap growth to value, it's still coming down, but looking more positive. Mid cap growth to value is flat, but still looking better. And we're pretty much flat, slightly declining here with S&P growth to value ratio. These are all end of day charts. And coming down a little bit with the growth versus value ETF, but we're now above the rainbow. We are improving with the large cap growth ETF. We're above all the plotted moving averages here. And coming down, but still improving with the discretionary to staples equal weight ratio. And this is another ratio that I've just started posting lately, US to international stocks ratio. And this is going down. That means US stocks are underperforming. They've been starting to bounce back. So we'll see if, and this isn't a trend line. This is just to accent what is happening here. If this continues to go up, that means US stocks are starting to outperform international stocks. And momentum stocks, again, this is kind of a trend line here because we were coming down in March and then we started to go back up. And then here's what everything was falling apart. We made a higher low here with momentum stocks. When we look at a ratio with the SPY, which is the ETF for the S&P 500, and then this has been going up. Even as stocks were going down, the momentum stocks were still performing quite well. All right, and we are starting to trend now in the short term. We're above the moving average, but it's not a confirmed trend because we're still below 20 in the short term, but it's positive with the green line above the red line. Also, intermediate term coming in above the moving average, but not above 20 at least yet, but it's positive with the green line on top. Volume just continues to be tapering off here, even for options expiration. It even dropped off in Friday's session. Sentiment, we're below 20 with the VIX. As we continue to go down, that's much more positive for stocks. And the VIX of the VIX also is below both of its moving averages with the bar chart and the line chart. That's positive. And with the momentum of the VIX, you could make a case that maybe we're getting a little extreme here with the MACD, but the momentum for right now continues to be down for the VIX. This is the speed of the VIX using an RSI based on 9 periods, just starting to come down to this lower end as the VIX has been falling pretty far. We declined with this other fear gauge that we follow, as well as this additional fear gauge. So that's confirming fears coming out of the market. We're still doing okay. This was virtually unchanged, the risk on to risk off ratio, but it's really been coming up lately. And that's more positive for the market as it switches back to being more risk on. And we did go up with the equity put call ratio daily chart. We're getting a really extreme negative reading with the 5-day chart, and we're continuing to decline with the 10-day chart. I've been keeping an eye on this because we were concerned that what we were seeing lately in 2025, a real breakdown of this ratio when we look at the SPY to staples, because that's what happened at the end of 2021. But this was a lot smoother. It happened with not a lot of recoveries along the way and just kept going down. We're here. We were falling apart, and I was trying to point this out here, but we've really been improving with this ratio lately. If we can keep going up, that would be more positive for the S&P. And we're coming up a little bit here with the volatility risk premium, but still below the band. Advanced decline lines, another day, another new all-time high for the advanced decline line based on price and volume. But we're seeing a bit of a negative divergence here. We're setting all-time highs in the short term, but the 10-day average still, it actually declined a little bit, and it's not really showing an awful lot of strength right now. It's positive since it's above zero, but it would be nice if we were getting higher readings with this. And the short-term advanced decline ratio, that's the blue line, that's starting to get extreme, but it's positive, and the red line continues to go up, and that's positive. That's intermediate term. So here's another way of looking at that. The advanced decline ratio, 19 periods, that's short term. We're getting extreme based on price, but we're also getting extreme based on volume. And we are improving with the new highs, new lows. We were a little bit concerned here as the new highs were dropping off and a possible expansion of the new lows. Now, in Friday's session, as we're breaking out a little bit, we saw an advance of the new highs. We're trying to turn back up with the 5-day chart, and we're slowly going back up with the 10-day chart. Here's accumulation distribution. We're positive since we're above the red line, and the red line, which is a moving average, is going up. And then the boom indicator is also still above its moving average. But you might make a case that we're getting kind of far away from the moving average. The smart money indicator number 2, your accumulation distribution is smart money indicator number 1. This is number 2. This is positive. The histogram's going up and the red line's going up. And smart money indicator number 3 is the Chaikin oscillator. Now this is positive, but when we get above the red line, we go, okay, we better watch this more closely. When we go above the green line, it's like, okay, we really need to watch this more closely. So this is getting close to that point. And we did improve. It was a little bit concerning after Thursday that the vortex actually was coming down on an up day. Well, we bounced back up with the green line with the vortex, and we're declining with the red line. This is still positive. And I haven't been showing these as much lately, the advanced decline studies that we do. I just go over mainly the raw numbers. But this is the cumulative advanced decline line for the S&P based on price, setting a new all-time high. Now that could be positive because we have not set a new all-time high based on price of the S&P. We're also setting a new all-time high here based on volume. That could also be positive, and that we're setting these highs before we're setting it with the price of the index itself. That means other stocks in the S&P are actually performing better and participating in the upward move. And then to look at the new highs, new lows, we are positive here. The black looks like a weird EKG. That's positive. And then there's a 50-period moving average over top of that. And that is improving here. In fact, I broke it out down below. We're still below zero, but it's starting to come back up, and that's longer term. And our advanced decline line studies looking good here with NYSE common stock, S&P mid caps and small caps all above their moving averages. Now the small cap moving average is flat. It'd be more beneficial if it would start to turn up. We are seeing a little bit of a turn up with the mid caps, starting to turn up with the S&P, and starting to go back up with the NYSE common stock. Haven't shown this in a while. This is an apples to oranges type of comparison where we're looking at the S&P, that's the bar chart, and then the NYSE advanced decline line, just comparing an index with an even broader part of the market, the NYSE, and they're confirming each other right now. In fact, the NYSE is actually outperforming just a little bit here. Even though they are on different scales, this is looking a lot more healthy. And then the NYSE cumulative advanced decline line, that's setting a new all-time high. We're breaking out to a new all-time high with the advanced decline line itself. And then I also have another advanced decline line, also just barely breaking out to a new all-time high here. That's positive for the market. Then we just look at common stock, not back to an all-time high, but improving. But when we look at volume, we are in the process of setting another all-time high here. So that could actually be positive when volume leads price. And then the new highs, new lows, the black line, that's the daily reading, or that's positive. And then the red line, it's really hard to see. It's on the chart right after this. We're starting to turn back up, but we're still negative. That's what we're seeing here, a real improvement. But we're not quite above the zero line yet. And then we look at another broad market measure, Amex, NASDAQ, NYSE, and take a 5-period moving average of the highs and lows. After we had become quite extreme negative, now we're starting to come back above zero. And the stocks in the S&P above their 20-period moving averages starting to get extreme. We're at 86.4% of stocks in the S&P above their 20-period moving average, and that's pretty high. We are improving with the 50-period moving average. And we're improving with the 100 and 200 period moving averages. And they are all positive. All right, here's the daily chart where I pointed out after Wednesday that we were finally able, actually it was after Thursday, we were able to get above this dashed line right here. That's a pivot point, and that was acting as overhead resistance. We're starting to break above that, and that is positive. And we're both above both the 200-day moving average in red and the 50-period moving average in blue, but we're still in a downtrend until the blue line crosses back above the red line. And we dropped off with volume on an options expiration day. Kind of strange. We are getting extreme with the 20-period exponential moving average on the S&P, just barely extreme here with the 50-period exponential moving average above 50 and going up with the 200-day exponential moving average. And then here, the usual charts showing positive momentum with the StochRSI, the Williams percent R, CCI 14, and CCI 20, and the Stochastics, extreme on all time frames when we break down the short-term time frame. And still positive here with the force index. The short-term trend is still looking good. Based on 20 periods, we're going up with the blue line and the green line. The 5-period rate of change still looking extreme. The 10 has dropped off, and I'll get to the 20. In fact, did I miss that? I thought I had the 20 on here somewhere. But you can see we're actually above the +3 channel here with the standard deviations chart. That's a little strange. We don't see that very often. These lines are usually more dynamic and they move quicker. They'll catch up. It's not that big of a deal. But this is just showing that we're extreme here. And a lot of times when we get up into this area, that can mean we either slow down or start to pull back. Intermediate term, balance of power is positive. Then the bow tie, positive with the green, red, and blue. That's when we're more positive. We see the order of the lines in that way. And we're still extreme with the CMB composite. The go, no go is positive. The highest high value, blue line, it continues to go up, and the midpoint's going up. We're positive with the Landry light, and we're positive with the proper order. TTM Squeeze, very high reading here, but it's the lighter shade of blue, which tends to be more positive. And longer term, you can see the very high reading that we're getting right now. We are going pretty quickly here. That's what standard deviation measures, that we're above the moving average. So stocks have been moving rather quickly. Ease of movement is positive. We're above zero with the 14-period version of the indicator. We actually dropped down a little bit with the Arun. We're no longer extreme positive there. And then the McClellan Oscillator starting to get extreme when we look at the S&P. We were seeing some weakness. Now it's starting to bounce back up. And since we're above zero, the summation index based on price and volume are positive. Now we're getting up to this red line here. Sometimes that can mean that we're getting extreme, but it is positive that we're seeing volume leading price. But we're not seeing that. This is another one of these negative divergences. We were up with the NYSE McClellan Oscillator, but we're not getting an extreme reading like what we're seeing on the S&P. So this is just a little bit of a concern here. But because we're above zero, the summation index for the NYSE based on price and volume are going up. And now we were negative with the Swindle Trading Oscillator after Thursday. It's now switched back to positive. We're advancing based on price and volume. And we're starting to get extreme with the PMO, the Price Momentum Oscillator. It's coming up to this red line, but we're still positive when we break it out based on price and volume. We're extreme with the PMOs that are rising, the percent. We're starting to get extreme again with the buy signals. And we're still continuing to look positive with the PMOs above zero. But we're still neutral. This is strange. We really came up here. We were up 0.7%, but the Elder's Impulse system is switching it or keeping it at neutral as when it's blue. But the parabolic SAR is positive since the dots are underneath, and we're getting really extreme here with the slope oscillator. That's short term. We're starting to get extreme with the MACD. So we look at this. Here's the slope oscillator. Higher reading than what we've seen on this chart. We're not quite extreme with the TSI, which is the other short-term oscillator. You could make a case, and this is more of an eyeball thing here with the MACD. It's a higher reading than what we've seen, where the PMO, you might make a case for it there, but we've had higher readings on this chart. And the PPO also getting kind of extreme, but we're still positive with our two longer-term oscillators. But they could also be starting to get extreme as well. Topic curve has been extreme now for quite some time. When we look at this longer term chart, we usually max out around this level for this indicator. And we're just kind of flat here with the Sean trend meter, but we're positive since we're in the green area. We're above 50 with the money flow, and we're starting to get extreme with the ultimate oscillator, which I did not put on the list. And we are above an advancing moving average with unbalanced volume. We're extreme in the short term with the RSI. We're not quite there yet with the intermediate term RSI. The 50-period moving average, that's the intermediate term, is improving as the red line is going above the blue line. And we're above all the moving averages. The longer we stay above these moving averages, the more they'll keep coming up and show signs of improvement. But we're far, far away from the 20-period and 50-period moving averages as measured by the boom indicator. And we're not really seeing an awful lot of strength here with the bullish percent index. We're actually dropping down below the moving average. That would actually be considered a negative signal, but we're still getting an extreme positive reading. And not really doing all that much with the NYSE bullish percent index and kind of coming down, but we're still extreme positive with the NASDAQ 100 bullish percent index. And we're above the Ichimoku cloud. And we're seeing the green line going up, the blue line above the red line, and we're above the cloud. That's positive. And we closed out the week above this pivot point now. And so this is still showing longer term support that had been regained and after we lost it. And now we've been able to build up off of that. So looking at all the different ways of measuring the trend, the Heiken Ashi is positive, the Kigi chart is positive, the Renko and the three-line break charts are positive. And we went up just enough here to generate a new X. We're still working off of this triple top breakout that was generated on April 25th. Long term, looking better with the 150 and 200 period moving averages. But we still ticked down to a 4. We had been at 8 with the Zohorchak. Well, first of all, we spent the last year at least at 10, and then we ticked down to 8, and then we had a couple of up days, and boom, it ticked down to 4. That's a little bit of a concern. But we don't use this chart in isolation. We use it as part of the bigger picture of things. All right, so we're in positive in the short term across all the stock indexes. We're still negative in the intermediate and long term with the small caps, where we switched over to positive with the mid caps. And the bonds are still negative across the board based on price, where commodities are positive in the short and short term, as well as the dollar. All right, and energy was the only sector that ended up being down, but we are still seeing more performance here by defensive areas. Healthcare, utilities, real estate, staples. Those were the better performing areas. We want discretionary communication and tech to do better, and they underperformed. And so we had healthcare having a BPI cross back above 50. The NASDAQ went below 19.1, but then it got back up to 19.2. And good old Canada set another new all-time high. So here's the market carpet. We're not a real big day for the mega caps. Apple was down a little bit. Microsoft was up. Nvidia was up. Small percentages based on what we're used to seeing. But you can see financials, pretty much all green. There's one little red in here. I don't know what that is. And then healthcare, all green. Industrials, that's more cyclical. That's looking better. Staples, that had a better day. But then communication, which is growth. Meta was down, but Google was up. And then discretionary, Amazon up a little bit. And Tesla was up over 2%. I mean, it's not like they're falling apart, but they're not really showing that real leadership role right now. And we look at the S&P weighted index, excuse me, that's the bar chart versus the equal weight. They're both doing pretty well right now. The weighted version is outperforming just a little bit because it's above the red line, even though they're on different scales. And we finally were able to break a little bit above the 200-day moving average with the Dow. So, and it's positive now year to date. And we're positive with the Elder's Impulse system with the diamonds. The NASDAQ still looking pretty good here. It was up 0.5%. The NASDAQ still neutral, though, with the Elder's Impulse system. NASDAQ 100 was up 0.43%, showing some improvement there. And it's still neutral, though, with the QQQs, with the Elder's Impulse system. The momentum for the NASDAQ 100 is positive. You might make a case that we're starting to get extreme positive here. And small caps, after finally getting above their 50-day moving average, they're still having a hard time getting above this R1 overhead resistance level. And we're back up to getting an extreme reading with the Russell 2000 small cap index. When we look at the RSI, showing an improvement, but still below the 200-day moving average here, but the momentum is still positive. And we're still neutral with the Elder's Impulse system for the small caps. Mid caps broke a little bit above their 200-day moving average. That's why they switched over to positive in the previous chart I showed. But they're still neutral with the Elder's Impulse system. Showing some improvement here with the Wilshire 5000 and also the total U.S. stock ETF. They continue to go up. Financial sector also still looking pretty good there. The FANG index still above both of the moving averages. And Apple was virtually unchanged, but down a little bit, still in a downtrend, but dealing with its 50-day moving average. Amazon was up 0.2%. See, not a real big move there, but above both the 50 and 200-day moving averages, but still in a downtrend. Microsoft in a downtrend, it was up 0.25%. Google in a downtrend was up 1.36%. Meta above both moving averages actually declined a little over 0.5%. Nvidia in a downtrend up 0.42%. Tesla in a downtrend up 2.09%. Netflix, another day, another new all-time high. Probably the best looking chart of the bunch right now. And we're seeing a little bit of a pickup here in the short term when we look at US to world stocks. Also, general improvement, but starting to flatten out here with the longer term correlation. Oil still in the lower 60s. The dollar is above 100, getting up into the 101 range, but still in a downtrend. It came right up to its 50-day moving average. And as of right now, that's acting as overhead resistance. We're going up here with the truflation measure of inflation at 1.85%, but it's still below that 2% that the Fed is trying to target. But this is not the Fed. This is just another company that creates their own inflation measure. And we have been coming down, even though we closed well off of the low here with the yield. We closed pretty much at the high, but we still dropped overall, and we're back below that 4.5% level with the 10-year yield. And we did close at the low, but we ended up going up with the 10-year based on price. Still taking a bit of a hit here with our growth to value ratios, but they're still above advancing moving averages. And when we look at the different indexes, also still above advancing moving averages there. So the outlook, we are still positive in the short, intermediate, and long term in reference to their moving averages. We're going to get LEI, the leading economic index, will be coming out on Monday. This upcoming week's going to be a lot less information coming out. We'll just have to see what happens with the trade wars, with the tariffs, anything coming out of DC, anything geopolitical that may happen. We always want to keep an eye on those things. And you can see it's a rather light week compared to what we just came out of. We don't have any economic reports on Tuesday. We'll get the weekly mortgage applications on Wednesday. We get that every week. Jobless claims, that's probably about the biggest one. And then we'll be getting some housing data later in the week as well. Here's also a look at this other economic calendar. Seasonally, not very good for May 19th. Negative across the board for the Dow, S&P, and NASDAQ. But on the positive side, we're now going to be in the week after options expiration, and that tends to be up 66% of the time. And then, oops, I didn't switch this over. We still see some positive seasonality here during a post-election year. So we're getting some mixed signals there. This is another way. Post-election years tend to bottom in early April and then rally. This will probably be the last time I show this chart. I'll switch it over to the weekly video here, where the averages that we have a difficult April, and then from there tend to do better. This is another way, the 4-year cycle for 2025 put out by NDR, and we're kind of tracking this. We're not really keeping that close to this, but the same basic pattern seems to be holding up fairly well, and that helps things look better, at least going out into the end of summer, into August. And then here are the pivot points, which have already been posted on the YouTube community tab. I really hope you guys make use of that. It's just amazing how accurate those things are. All right, the warning signs, we still have longer term downtrends with the growth to value ratio for the S&P as well as discretionary to staples. The long-term special K chart, it's negative, but it is improving, but it's still below its moving average. And we're still positive here with our 3 smart money indicators. We're positive with the McClellan Oscillators and summation indexes, seeing a little bit of a negative divergence between the S&P and NYSE. Bullish percent indexes also coming down a little bit with the S&P version there, but giving us an extreme reading. The parabolic SAR, we're extreme with the 20-period moving average study. The swing trading oscillators back to being positive again. The momentum is positive, possibly looking extreme with a few of our momentum oscillators. Ease of movement, money flow, ultimate oscillator. This is now getting to be extreme with the ultimate oscillator. The vortex is positive and now showing a little bit of strength. Financial sector is looking positive, as is the momentum for the NASDAQ 100. But with the PPO, you might be thinking that we're getting a little extreme with that indicator. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, This approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. So our conclusion, we are still positive in the short, intermediate, and long term. We're seeing some negative divergences in the short term, but we are overbought. We're pretty much that same thing in the intermediate term as well. And we are now positive still because we're above the 200-day moving average in the long term, but we're still dealing with a downtrend. Thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.